So this is our second law, the law of cause and effect. This is an interesting law, and for those grounded in physics, I'm sure you are familiar with Newton's third law of motion. For every action, there is an equal and opposite reaction. And just to clarify, this is not to be confused with the spiritual law of cause and effect, where good deeds bring good results and bad deeds bring bad results. Our deeds and actions, the cause, determine our fates, which of course will be the result. So what does this really mean? And how does this apply to our trading? Well, every action, the cause, may come in the form of distribution, accumulation, trading ranges, buying and selling zones, and that of an apex. And we know an apex, we've already mildly studied the internal workings of an apex, and we know that a cause is built as price tightens. Then as it's released, the price coming out, the trend, is the effect. So these all create cause, and the effect is the breakout, it's the preceding move. And the effect should be, this is very important, the effect should be in direct proportion to the cause built, a 1-to-1 ratio. And this is the basic way in which markets operate from a macro perspective. If we zoom out of our charts, we'll have trading ranges where we build cause. When we break out, this would be the trend, which is the effect. We have another trading range where we build cause. We break out, which would be the trend, which of course is the effect. We have another trading range. We build cause and we come down. So we build cause here, and this is the effect, which is our downtrend. And so it goes on, trading range, we come down. But the effect, of course. However, there are two important parts of information. The cause, as we said, is where the energy is built. In this case, a trading range. And the greater the cause, the greater the effect. And we've previously spoken about that the cause should be in a direct proportion to the effect, a 1-to-1 ratio. Okay, let's go on to the studies to put these concepts and principles into play. Here we have a study of the second law, cause and effect, Euro futures, using a 15-minute time frame. With a quick glance, we can see how the markets tend to move. We have periods of sideways action, which are trading ranges, that build cause energy for the forthcoming trend. So this would be our cause, the effect, which is the trend up. Cause, the effect, which is the trend up. Now let's go through this chart. And before we do, don't forget that we must remember Newton's third law. We want a 1-to-1 relationship between cause and effect. For every action, there is an equal and opposite reaction. Okay, so A, we build this cause, and this is the effect. In sync. B, we build this cause, and this is the effect. Excellent. In sync. Okay. C, we build cause, we get a good move down. In sync. Then at D, what do we know? Well, we have a trading range and we bounce around, building energy, building cause. Then as we break, it's unproportional. Therefore, the cause was greater than the effect. And if the cause is energy and we haven't used all the energy, being the effect, we have stored energy. We have unspent energy. And this is physics. We have to use that energy at some point. And as we come down, we have a trading range, and we come out proportionate. Then we have another trading range at F, and then we push up proportionate. Then what happens? What happens from here? We slam straight down with hardly any cause. So what does that mean? Well, it means we're using some of this stored energy from D. The energy has to be used at some point. It's the nature of the universe. So as we slam down, we use some of the stored energy from D. We know that there must be some stored energy from D. Why? Well, because look at the move down here, and then from E, look at the move to F. It's the same distance made in terms of price, but compare the energy built here to here. We have 2.5, perhaps 3 times the amount of energy built in D than to E. Yet the move out, the effect, is the same. That cannot be right. This is an anomaly. It's incorrect. Then at G, we bounce up and down. Don't have a great cause here, yet we fall very nice. So we get a decent move. And we'd say it uses all of this energy and any leftover energy from D. And now we're back in sync. Then at H, we have a large trading range, which creates a large cause. And we break out and continue north very nicely. Can you begin to see how this works? J, what do we note? Well, we build good cause, we have energy, and we break out the trend. The effect is disproportionate to the cause built. Therefore, we have stored energy left in the market. Because this move, this effect, is far less than the cause built. So we have stored energy, just like over at D on that move down. And then we build more cause at K, and then boom, we slam straight down. Now ask yourself, does this cause have enough energy to create this move down? No, the effect is greater than the cause. How can that be? Well, it's using the stored energy from J. Can you see how this works? It's very, very fascinating. It's very advanced use of cause and effect. And then L, good cause, decent move. M, little cause, little move. So we're back in sync at L and N. So how do we use cause and effect to our advantage? Well, if we're in position, we can hold on to the trade for much longer because of the stored energy that we know is present. Example, say H here. This is a nice trading range where we accumulate. We know we accumulate because we push up. As we're building cause and we spot this spring here and we trade this spring, our first target would be a resistance area, but our main target would be the highs. Why? Because this is a lot of cause built. So if we get out here and we come in here, or get out here, we know there's a lot more energy left. So there's a lot more potential ground we can drive higher. This results in higher profits. There is enough cause for a strong move. If we take a spring or any trade within a trading range, be aware, be mindful of how much energy or cause has been built. That's one of our major components from cause and effect. And we can see it works. The cause and effect all over this chart is pretty much in sync. And when it isn't, we break, we fall hard. It's pretty much instantly resolved. It has to work. It's physics, so there is no doubt. It's just very helpful to understand this concept of cause and effect displayed in this manner. See this cause here, okay, and this cause here. If we take this spring here, we're not going to hold for here. Why? Because this cause is disproportionate to this effect, which is the move up. But here, where we have the cause, we can take it to here. Why? Well, because we've got all this energy. And that should be able to propel us to the last major swing high. So the main two uses of cause and effect are, if we have unspent energy, like from here, and we drop down hard, like we do from K, the market's hinting there is a potential change in trend. And we want to be sellers. So when we come in for this day, and we got this big strong move down, we want to continue trading with the trend, which obviously gives us an edge for that day in question. And also, if we're in a position, be mindful, be aware of how much energy or cause is built. This enables us to hold on to the trade longer, which obviously equates to higher profits, potential profits. Now, please don't get me wrong, this is a very advanced use of cause and effect, providing deep insights into the rhythms of the market. Not just that the market flows from trading range into trend, back to trading range into trends, etc., but the importance of energy. And we need to see the one-to-one relationship between cause and effect. And if we don't, there is an edge to be obtained. Now, this type of analysis is extremely useful for higher time frames and swing trading. I mean, clearly this works for smaller time frames. We're using it here on a 15-minute chart. But reading the lack of effect after a trading range, which would be an anomaly, we're out of sync. The cause and effect relationship has been compromised. We must pay close attention to the price action thereafter, as it will often tip its hand for very good trading opportunities. Why? Because there's stored energy for a move. And we have to use the energy. It's a law of physics. Hence, we get strong moves. We get strong moves that slam down. If we can position ourselves correctly, we can take advantage of these situations. And it alerts us to possible changes in sentiment and or trend. Good. Any questions for this chart? How do you know which way the effect will break? Good question. First of all, here we can see we're in a downtrend. And it will take a trading range like this to halt progress and create a new trend. Hence why we get large trading ranges at the end of good moves, exactly like this, after a move down. I mean, think of it like the example from the last session where we have a swell in volume. In the last session, we had a swell in volume and we did a bar by bar analysis where we could see the shift when they went from sellers into neutral and into buyers. And this is on a very small time frame using individual bars. Here, instead of examining the individual bars within this trading range, we can examine the legs, the pushes. And we'll note the buying and selling forces within the legs, within the trading range. So it's exactly the same principles as the bar by bar, but we're using the legs within the trading range. So going back to your question, how do I know which way the effect will break? Well, like I said here, because we're in a trend channel and we have a large trading range, the effect should be we break to the upside. And it takes a large trading range to change the trend. We need to halt progress, stop all the selling, Then we need to build a cause, which is buying, to enable us to push up to the highs. And that takes time. Here, this takes 4 days on a 15-minute time frame. So when we come here and we have these small trading ranges, we want to look for short plays. Why? Well, because it's highly unlikely we're going to push up higher with very small causes. Why? Because it takes this kind of trading range to halt and push the market in a new direction. Of course, it's possible. I've seen it many times, like V-spike reversals. However, that's more exhaustive moves, where they exhaust supply and they can push it up with very little force. Good question. It appears there are no further questions. On to the next study.